Two people invest the exact same amount. One retires a millionaire, the other falls short by $500,000. They didn't pick different stocks, they didn't have different salaries. The only difference is time. Welcome back to Learning with Pratik. If you're new here, I try to increase neuroplasticity by exploring a new topic every day. I do all the reading and researching so you don't have to. Today, we're exploring a deeply fascinating mathematical reality. We're going to pull apart the mechanics of exponential growth and uncover the hidden forces that either build massive financial empires or silently erode them from the inside out.
Section 1. The Mathematics of Money. To really understand how wealth is generated, we first have to establish the baseline mechanics of how capital grows over time. We're looking at simple interest versus compound interest. Now, if you invest $6,000 at a 3.5% rate using simple interest, which just means your growth is only ever calculated on that initial principal, you'll end up with $12,300 after 30 years. Not bad, right? But when compound interest engages, the entire mathematical landscape shifts. Growth is now calculated on the principal plus all the previous gains. Your interest essentially starts earning its own interest. That exact same $6,000 becomes $16,840. It's the literal difference between linear addition and exponential multiplication.
So what happens when we change the frequency of this calculation? If you look at the formula for monthly compound interest, the crucial mechanic is right there in the middle. The division of the rate by 12 and the multiplication of the time exponent by 12. By calculating and adding the interest back to the principal every single month, rather than just once a year, you drastically accelerate the growth curve. The compounding engine just turns over faster, creating a much steeper climb for your wealth.
Section 2. Pushing to Infinity.
Which brings up an interesting question. If monthly compounding yields more than annual compounding, what happens if we calculate interest daily or hourly? What if we compound every single millisecond? This brings us to an absolutely beautiful concept from higher mathematics, Euler's number. It's denoted simply by the letter E, and it's approximately equal to 2.71828. This mathematical constant represents the absolute ceiling of continuous growth. Think about it like this. If you took $1 and compounded it continuously at a 100% interest rate for exactly 1 year, your money wouldn't just grow to infinity. It would actually hit a mathematical wall, growing to exactly $2.71828.
When we push the frequency of compounding all the way to infinity, our complex monthly fraction simplifies incredibly elegantly into this: F equals P times E to the power of R times T. We shift completely away from discrete, jagged monthly steps and move into a smooth, continuous, uninterrupted curve. It's a formula so fundamental to understanding growth, it's actually the bedrock of advanced finance models like Black-Scholes. Let's put this continuous formula into practice, just to see it in action. If you invest $100 at a 6% interest rate, compounded continuously without interruption for exactly 5 years, it yields exactly $134.98. That specific number represents the absolute maximum theoretical return for that specific rate and time horizon.
Section 3. Fueling the Compounding Engine.
Okay, let's step away from the academic blackboard for a moment and look at the practical reality of everyday investing. Because this mathematical engine we've just built, it requires fuel. And the most potent fuel isn't actually capital, it's time. Consider two hypothetical savers. They both plan to retire at age 67. They both earn a 7% average annual return, and they both contribute exactly $6,000 a year. But here's the catch. The first saver starts at age 25, while the second saver waits just 5 years, starting at age 30. The results of this delay are frankly staggering. The person who started at 25 retires with nearly $1.5 million. The person who waited until 30, they retire with just over $1.05 million. A mere $30,000 difference in actual out-of-pocket contributions created a massive $450,000 gap in their final wealth. That 5-year head start is exactly what allowed the exponential curve to fully engage. To harness this kind of exponential growth in your own life, we can draw 3 key strategies from the data. First, invest early to maximize your time horizon. Time is the one variable you literally cannot get back. Second, invest regularly. This strategy, often called dollar-cost averaging, allows you to mechanically buy more shares when market prices are down and fewer when they're high, which naturally reduces your overall risk. And third, diversify. By spreading your capital across broad market index funds, you protect your compounding engine from the failure of any single company.
Section 4. The Hidden Wealth Killer.
Now we have to address the antagonist of our explainer, because the exact same mathematical engine of compounding that builds your wealth can, and absolutely does, work aggressively against you. Let's take a $150,000 portfolio growing at 6% over 15 years. If you pay a 0.2% annual fee, your portfolio reaches roughly $349,000. But if you pay a 0.8% fee, you end up with $320,000. A seemingly harmless 0.6% difference in fees silently erodes over $28,000 of your hard-earned wealth. And remember, you aren't just losing the fee itself, you're losing the future compounding power of that capital.
So, where are these fees actually coming from? Well, they're intentionally layered and notoriously hard to spot. Transaction fees aren't just direct commissions anymore. They include things like bid-ask spreads, which is the invisible difference between buying and selling prices in low liquidity markets. Ongoing fees include advisory charges and layered expense ratios that are quietly siphoned off your balance annually, completely regardless of whether your portfolio goes up or down. And then you have performance fees, which take a direct, aggressive cut of your actual gains.
The catastrophe of high fees becomes remarkably clear when we stretch the timeline out. Over 20 years, investing $100,000, the difference between a low-cost 0.1% index fund fee and a 1.5% actively managed fund fee is just devastating. The high fee costs you over $73,000 in lost potential wealth. That is quite literally compounding running in reverse, aggressively eating away at your future.
To neutralize this threat and protect your compounding engine, you really must take active steps. You should review fund prospectuses, specifically looking for hidden marketing and distribution charges. Consolidate your investment accounts to avoid overlapping maintenance costs. Seriously consider leaning into low-cost index funds instead of expensive, actively managed alternatives. And constantly monitor your accounts for inactivity or platform fees that quietly drain your capital while you aren't looking.
Which leaves us with this final, critical thought to ponder. Are hidden fees secretly compounding against your financial future? Let me know your thoughts in the comments below, especially if you have something particular in mind. Thanks for watching. Tomorrow we open a different page. Until then, Pratik out.